Welcome to Market Radar. We're not investment advisors, security analysts, or brokers. The following information is strictly for entertainment and educational purposes only. None of the information here is intended as a buy or sell recommendation. It's another Market Radar podcast. It's Saturday, August 13th. Let's start with the year-to-date performances. Huge day in the market this week. S&P year to date now only down 10.08%. Nasdaq down 16.96%. Russell down 9.93%, and the Dow Jones down only 7.02% year to date. All of these indexes are still bearish trend though. They are coming close, especially the S&P. It is coming close to Momo. And, when you get a break of Momo, that's when you get a trend flip. So we'll see how that goes. Our regime system still in stagflation. Total risk off percent chance of 61%. It is diminishing. We are seeing inflationary odds come up. Inflationary odds now took over deflationary odds. We'll see if we get a risk on regime. It's very possible. It's definitely possible, and that's gonna blindside a lot of people. So we'll see how things play out, but we don't rely on one thing. We've got the system regimes, but then we also have DDAP. Both have to line up. We're not gonna go risk on if all of the indexes are still bearish, even if our system switches to risk on. So that's how it works. It kind of catches itself, and it works out to being a very good track record. Let's look at the calendar for next week. Monday, we've got Empire State Manufacturing Index, Housing Market Index, and Fed Waller speaks, and then Treasury International Capital. Tuesday, we've got Housing Starts and Permits, Industrial Production. Wednesday, we've got Retail Sales, Bauman Speaks, Business Inventories, EIA Petroleum Status Report, and the FOMC Minutes. Thursday, we've got Jobless Claims, Philadelphia Fed Manufacturing Index, Existing Home Sales, EIA Natural Gas Report, George and Kaskari speaking, and the Fed balance sheet. Friday, we've got Barkin. That's it. Now let's look at what ES did this week. This was a huge week.
Let's unpack this one. This one is really interesting, right? We
Yeah,
have
this is really having bears question their sanity. This
I
is what
love
we
that.
warned about. We
I
warned
love
about
when that
this.
happens. I love when that happens. You know what? It reminds me a little bit about just what happened a few months ago in March, right? We had the market really just, I mean, let's take out the measuring stick real quick here from the lows. We had the market run like 12%, right, in a straight line. And everyone was, we had a lot of the trend line crews, the tech, what we'll call them the technical traders. They came out and they said like, "Oh, look, trend line's broken right here.
Yeah,
Uh, we,
all-time
we take out
highs.
we take out this level. We're gonna do this some type of Pythagorean triangle fill or some ridiculous shit. Does it work? Obviously it didn't, and the thing ES got smoked. Went neutral though, fell back to bearish and just shit the bed. Um, we now have ES pretty much running about 17% off the lows right now. This is not as aggressive as it was in March, but we have ES actually going up towards Momo at a slower rate this time. So instead of accelerating like a rocket ship, we have it pretty much doing pretty much micro consolidations along the way, right? So we have these pumps, these like slight fades, and these re-rallies taking out those highs, and that's what you've been seeing the last few months here. And we did mention back in sometime in July when ES was kind of perking up here. We were like, or it must have been late July, right?
Yeah, it was a
Already,
while ago. I think
or
it was around there after we bounced off the lows.
Yeah.
We did mention that Momo is a possibility, and you don't want to be caught over leveraged or shorting too early.
Right. And that's why, again, our portfolio is going to swing because there is leverage in there, but our portfolio is holding a large portion of cash specifically for what you're seeing right now. I'm not saying like, oh, we're geniuses. We're gonna, we're giving you the next penny option that's gonna, go up 10,000%. We're just telling you that what you're seeing right here is perfectly normal for the stagflation regime. This is not something that has me immediately concerned. Now, what Artie said at the beginning of the podcast is quite interesting that inflation has overtaken deflation. Something to watch. But stagflation still does lead by over 10%. So and the system strength has decreased greatly in the last 3 weeks. But that's because what's happening. So those that are watching and want to better understand what we talk about, what's going on here? Why is the system strength fading? Well, what the market is doing right now is what we would call a counter trend move, right? So the trend is bearish. It's a risk off regime, meaning prices should decline. Prices are no longer declining; they're actually going higher, right? So they're doing something they shouldn't be doing within the regime. But this is what we would call a counter trend regime, because the regime and the trend are both telling you that prices should go down, yet they're going the other way. Now, what the system is picking up on is it's picking up on an underlying shift in performance of the components of the system. Basically, the system components are changing.
Yeah,
Okay, or they're going
and
the opposite.
something
Go ahead.
important to note is look at expansion. So expansion is the growth proxy. So growth is what matters in expansion because you don't have inflation, but you have growth. And we're
Right.
seeing that coming back. So
Right.
there are aspects that are occurring right now. There are things in the market happening right now which are signaling a potential comeback in growth. And that's
Right. And
what we
that's
need for an inflationary regime.
right. And that's why you're seeing both expansion and inflation lift off their prior month's values. Like if we go back a month, right, we were at 3.5% for expansion, 16.7% for inflation. Now we're sitting at 14.2 and 2.49% respectively. So those values have lifted quite um, those values have lifted rather aggressively in a 1 month time period, and that's most most of that action is due to what you're seeing in the market. The market's pretty much this type of price action is risk on. That's what this is. When you see ES on a 15-minute do this, let's take off DDAP so you guys can see. When you see this is risk on,
Yeah.
right?
But
No,
now
all,
what we have to
all,
watch out for is to make sure that the system doesn't get tricked by this move. If this
right.
really, if we still are, which we are in a risk off still, it's not flipping. But if it does flip to risk on, we got to be wary and we got to make sure we do our homework and see what caused the flip.
Right. So let me also clarify this. I think it's important that we make note. This is risk on price action, right? But this is what we call a counter trend move. So risk on price. Every regime has a counter trend component to it, right? For example, here this was. Let's go back in time, right? This is risk on, right? In September of 2020. This right here is a counter trend move. Things trade risk off for a bit, but they gravitate back towards their current regime. So what we're seeing right now is a risk off environment with a risk on move. This is not saying the regime is risk on, it's time to get bullish. This is saying that the price action you're seeing, the way that your portfolio is navigating is a rather risk on environment, right? We have bonds down, equities up, we have small cap names ripping, right? This is risk on. That's similar. It's what you would find in a risk on environment. But in the broader scope of things, we're in a risk off regime. So importantly, the most important thing you need to pay attention to is what's going to happen next. Like, are we going to hit Momo and fade, like as we did last time, or are we going to sit around Momo, chop around, trend goes bearish, neutral, excuse me, and then goes bullish? That's what we have to pay attention to.
Hmm. And this will also open up the door for some plays. We did
Right.
place a trade this last week as we're coming into Momo. Entering trades at Momo is the ideal entry because you have your set risk. So
Right.
on a trend flip, that's your stop loss. You're out. And so there is a potential here as we are still in a risk off environment. It's still bearish trend. The underlying economy is not looking too great as you know from our past few months of podcasts and what bonds are pricing in. We're in a rate hike environment. There is an opportunity to enter a short position at Momo.
Right.
And I think we might take one. We might add to our position in this coming week, depending on what happens.
Yes, I think it's a good way to basically sum up what you just said is let's just go back in time here real quick and let's just say for example, uh when we're going to take an ES bullish trend, put the regime aside, and this is just to explain what Artie was just saying. As you dip, a lower vamp is a great place to put on some size. But Momo is the line in the sand. For example, you could have been buying here. You could have been buying here. All great entries, right? Place to put the position on. Ultimately, in the right regime, you'll make money. No big deal, right? But for example, over here, if you put the trade on at Momo, you're out. You're out here as to where if upper vamp were to be much higher as it was over here, right? Upper vamp's way up here, and you have to break Momo and and flip trend. You have a wide, basically ass smacking area where you can get smacked around. So it's always best, or the best risk management is to put on trades by Momo. It's not the most realistic though. It's not going to happen all the time. But when you see it happen, you should definitely try and take advantage of it. And something that's pretty much at Momo right now is high beta. This we're sitting right at Momo. Now, the problem with this is we're sitting at Momo. ES is not there yet. So what you could have is you could have a small overshoot, and we're likely going to add it to our excuse me. We're going to likely going to add to our index short rather than our high beta short because it's obviously a bigger index. You're looking at a bigger trend, a more powerful thing compared to like high beta, which can be a little floppy. Always when we go with indexes, we always like to be in the bigger size in indexes rather than the small subsectors. Now they're not small, but just subsectors in general. But I think that should pivot us right next to bonds, right? And see what they did last week,
Yeah,
which
so bonds continued their sell off last week, even after the CPI report,
yeah,
which
that's
is
interesting,
interesting to
isn't it?
note.
Yeah, the Fed pivot, right? Where's the pivot?
Yeah. Well, you see the CPI 0% inflation as the administration came out and said we're
Right.
at 0%, so
They have
inflation's
a
done.
funny they have a funny they have a funny way of doing it, right? They're going to compare 0% to month over month data, whereas
Yeah, but it's just they know what they're doing, you
I
know?
know they know
Like
what they're doing. They're not.
it's
Yeah,
scummy. It's just
it's
scummy. They
scummy. It's
know
scummy.
people are going to misunderstand what that means and it sounds better. That was their plan all along, you know? It's all bullshit.
Okay,
But
and
anyway,
I think
not getting
let's
political.
yeah,
Let's
let's not go
talk
that
about
route.
how the market reacted to that though.
Right. And what I have on the chart right now is something very simple for those people that want to argue that the Fed is going to pivot. I'm going to show you right now what a Fed pivot looks like. So at the end of 2018, well, I thought it was at the end here. Sorry. So let's go to December 2018. Right. This is when we had the Fed pivot. Whatever. For the sake of it, this is fine. This is what a Fed pivot looks like. Astronomical rise in bonds. Okay. Now the bond market is not stupid. The bond market figured out that the Fed was likely going to pivot prior when it started rallying. When they said the Fed can't do this, that something's not adding up. Right? We actually
Hmm.
had
We got deflation back then too. Our model
we got
picked that
yeah,
up before the Fed pivot as well.
right. So now we have the bond market is actually no higher than it was in May, Okay, and inflation is no higher than it was what in March, right? 8.5% now is what we were at in March, something like that,
Yeah.
right? So nothing has changed here. Bonds are still in the same like sticky, shitty environment that they've been in all year. Like, there's no reason for you to be to have an oversized bond allocation in the current environment because remember this: when there's a directional regime, you will have a lot of fun with us. There will be lots of things to do, lots of resizing, entering back in, trimming. It'll be fun. It'll be almost like you get to day trade on a bigger time frame. It's really what's going to happen, right? We're not day trading, but you're just managing the position accordingly. There's a time and place for that. This is not the time or place to think that it is it's lottery season. Like, oh, I'm gonna just buy bonds and I'm gonna, just average down and collect my yield. Like, yeah, okay, you could do that. That's what the 60/40 is for. And obviously you can see where that went this year. That went right into the shitter, right, with all the other guys.
Oh yeah.
Yeah. So there's a time and place to be leveraged out in the space. Now, if you're the guy that says, I'm looking at the 10-year and the 270 basis point yield or whatever it's at right now is really lucrative. I think that over the next 10 years, it's going to be a good yield. Okay, go buy your bond ETF, collect your dividends, whatever. I understand that. But if you're on Twitter and you're telling other people that now you need to buy bonds because inflation has peaked, the Fed has pivoted, and bonds are going to perform well, you are not making the same statement as buying bonds for dividends. You're making a speculatory statement against what the Fed is going to do. And that is just not what is going on right now. And we're going to talk about that a little bit more when we go over how the CPI basically affected the general market and where the effective federal funds rate curve shifted, the forward curve shifted after the CPI release and the preceding 2 days. So we're going to go over that. But long story short, you cannot take something that that involves precision and then be wrong and then just say like, oh, it's no big deal because eventually rates will. For example, I think an example would sum this up much better. Let's just say rates are at 2.7%, right? You're like, oh, the Fed's going to cut rates to zero at some point. Most likely, I mean, I would bet at some point they will. I think everyone knows that's a reasonable bet, right? So if you buy bonds today, at some point you're going to be right? Well, yes, that's true. But what happens if bonds go to 4% or yields go to 4% before they go to zero, right? So you end up being David Hunter because David Hunter is right to a certain degree where yes, we're going to have a melt up at some point. The Fed is going to basically crush yields. Yes, this is all going to happen down the road. But at what point? Because right now he's been calling for this ever since the market started falling apart in January.
Yeah, so like how big of a drawdown are you
Right.
going to take to be right? And at that point, you're taking a 30-40% drawdown before you're right. What's the purpose of that at that point? How do you go in with conviction and put real money into a trade where there's a 30 or 40% drawdown potential?
Yeah, you know what's funny is a lot of people on Twitter, and I think everyone knows who I'm talking about, or the people I'm talking about when I say this. They all have these model portfolios. Okay. Oh, my allocation, I got 10 basis points, or excuse me, 110, 150 basis points here, 150 basis points there, 10 basis points there. It's all about minimizing drawdowns, right? It's all paper. It's all paper trading, right? They're telling you where their allocations stand. Someone released a picture of a screenshot or a screenshot of some other individual's chart on Twitter about a certain yield spread or rate spread against the federal funds rate. I'm not going to name who did that or who the chart was from. You can go into the chat and find out yourself. But that person, that specific individual on Twitter, notes his allocations as percentage. Oh, these are my allocations, right? We're one of the few people that you can find on Twitter that we are transparent about our positions. It's real money. So if we're down real bucks. If we're up real dollars. It's not bullshit. We decided to throw 10 G's into an account for, just for you guys. So you guys can see like, oh, okay, this is what's going on, right? Now, is it like, is it nothing? No, money is money, right? So even no matter how much money you have, 10,000 is 10,000. You can go to the nicer restaurants, you can buy nicer things, but 10,000 is 10,000 to everyone, right? Now, it might not feel that way, but for the purpose of what we're doing, $10,000 is is our account. Now we expect off of prior results to compound that ridiculously for you guys, with you guys in real time. We can show you back test screenshots of what we've done in the past. That does not matter because back tests are bullshit. It's the bullshit back test because I can show you the best back test in the world, right? Now, granted, what we've done in the past is extraordinary, but I'm not going to show you that because I'm not going to trick you into thinking that you have found something. I need you guys to see that this works over time in real time. Because what's going to end up happening is if I show you how this has worked in the past, you are going to commit too much money too aggressively, and you're going to take a drawdown that you do not deserve. What you're going to do is you're going to, you know, if it's a HELOC, if it's something stupid, which I would never recommend anyone do. Again, we're not financial advisors. You have to do this at your own speed. The whole point of showing you without showing you big size is to make you believe it works from day one. Okay, excuse me, make you believe in yourself that this works, not me showing you something. Because if I showed you a portfolio that was swinging like $50,000 to $100,000 a day, you would think, oh my God, like this is, you know, all I have to do is hit 4 days like this and I'll be set. Meanwhile, you don't understand that there's a risk dynamic that comes to drawdowns and so on and so forth. And I don't want to get into that whole scope. I just want you guys to know that step by step, we're going to take this from the ground up so you can build confidence along the way. We're not selling false dreams. We're not selling false, false ideas that you're going to be rich overnight. Everyone that is in this chat by now should know that this is the long game. This is not the Warren Buffett game, though. This is not, you're going to be, 67 years old by the time, you triple your account, or I should say, 10x your account. That's not what's going to happen here. But I'm explaining to you that you're going to need to take this step by step, day by day. This is not a get rich overnight scheme. And I think that we can now segue into what actually happened with inflation, with the liquidity situation in the past week and inflation. So
Yeah. So liquidity goes both ways, right? Low
right.
liquidity goes both ways. And that's what we've been seeing in this rally. This has been a low volume, low liquidity rally.
Right, and let's bring up ES and let's just run this back and forth so everyone can understand what we're talking about, right? So let's throw up volume. Last time, right? We have basically. I'm not even going to bring up last time. You know what? We will. Last time we saw equities rally and volume kind of fall off a cliff, right? Equities are rallying, but volume keeps fading, right? And equities are not rallying slowly like they did here. You see how equities trend higher day by day, squeezing out gains, right? This is like a low VIX environment or compressed VIX environment. You're having volatility spurts to the upside, which when you see volatility blow up like this, right, where you're having 2% days on the indexes, right, 169 basis points, 122, 258, right? This is the post FOMC, right? But you understand the point. When you see this is short squeezing. Just as this, when you see things drop 230, 288 basis points, for 377 basis points, that's people panic selling. Okay, this is short squeeze panic buying. This is panic selling, people getting decimated. That's the difference, right? So when you see these equity indexes squeezing the way they are, they're doing so because number one, volatility is low. So low volatility is like a self-fulfilling prophecy. As volatility gets lower and lower and lower, right? And we can look at VIX here. As volatility dives like this, it's like, oh, okay. So it's easier and easier and easier to get convinced that the market is shifting. Oh, VIX is lower, VIX is lower, VIX is lower, because VIX is mean reverting over time, right? It'll come back down, right?
Mm-hmm.
That's why volatility in ETFs are just they're via options or futures, depending on which one you're looking at, but they get degraded over time because VIX itself, volatility is always going to reverse, right? No matter how high it is, we don't see VIX sitting at 84 for weeks, right? Or VIX sitting at 50 for weeks. It always comes back down, right? It comes back down towards that 15. The average is like anywhere from like 15 to 20 over the last couple of years, right?
Hmm.
So as VIX comes back down, people are like, oh, well, this volatile environment might be behind us. So it's more and more enticing to get long equities, right? But we had someone actually ask this question in the chat, and we went over it a little bit, that VIX is almost, or volatility is almost a contrary indicator because it's a measure of complacency, right? You never like. Here's a good example. Think of VIX as the as the cost of insurance, right? So if VIX, we're going to call it $19 for an insurance policy. We're going to keep it simple right now. $19.52 for an insurance policy, for home insurance. I'll call it flood insurance, right? Well, if the insurance policy is up at 34, right? Well, obviously there's a higher chance of being flooded. Wouldn't you want to own flood insurance when it's low, right? When it's
Yeah,
cheaper,
exactly.
right? And that's because what ends up happening is, again, when VIX is rising and ripping, it's a self-fulfilling prophecy of, oh, the market's going to continue to get worse. I need to hedge. The cost of hedging just continuously rises because more and more people are like, oh my God, it's a self-fulfilling prophecy of where you have to consistently hedge more and more and more, right? And volatility just keeps rising because people, again, keep getting liquidated. If it's shorts, if it's margin calls, whatever it is, most likely it's people that are getting liquidated from stops, excuse me, not shorts or margin calls. And that's what's going on. People are dumping, dumping, dumping. Volatility is rising. People are getting more scared, so on and so forth. Now, what we're seeing right now with liquidity is we're seeing this market rally the way it has been, but the dollar, where we are with the dollar, we're at 105. The last time the market did this in March, the dollar actually, where was it? It was here, right? The dollar was at 97. And the dollar is our broad measuring market liquidity is not as simple as you'd like it to be because there's many facets to it. So the three primary things we look at is, and we have a whole video about this, is the dollar, is the adjusted national financial conditions index, the ANFCI, and VIX. Those are our main three liquidity components. Now, what they're basically showing you is that ANFCI is basically off the highs, right? We're back into negative territory, which is looser than average financial conditions. Okay, understandable. But the dollar is not anywhere near where it was last time we were here. Last time ANFCI was down this low, the dollar was at 98. Now we're at 105. So the dollar is telling you that there is still a broad-based situation of illiquidity that's going on, which would make sense that given the market's rallying the way it is, right? So the market is basically the swimming. Think of it like this: it's easier to, if you have your bathtub and you fill it halfway up, it's easier to push that water around than it is with a full tub of water, right? So the more water you put in the bathtub, the harder it is to move that water around. Similar to a bucket, right? You fill a bucket up halfway with water, it's easier to lift than a full bucket of water. And think of that as liquidity. So right now, buckets are filled less than they were back in March when the market actually was able to revert at Momo, which makes me think that it's very possible we could get a blow up a little bit past Momo, right? Similar to what we've seen here, but maybe a little bit more, and fade, chop, and go down. Now, the aggressiveness off the lows that we're seeing here, where ES is rallying, is making me think that it's going to be a little harder to switch trend because DDEP's smart enough to know that what's going on here is most likely a counter trend move, and it's going to put some weight on that counter trend move. So it's going to say, okay, we have to let, like similar to how it let some room in here before flipping trend, it's going to give it some margin, okay, a dynamic margin that's going to calculate, okay, some price acceptance above here might be necessary to keep the trend intact,
Hmm.
which is what you saw here, right? We saw price dive a bit before the trend flip because again of how volatile things have become, okay? And price acceptance below is, while it didn't really happen up until this point, was to be expected. It's a possibility where the trend can shift. Normally, this is such a we saw ES fall. Let's do some quick measurement. We saw ES fall about like 3% before the trend shifted. Here that we actually saw a trend shift. What was it 64 basis, about 1% off Momo. So it's not the same every single time. It's not like, oh, there's a margin, there's a cushion. No, it's dynamic.
Yeah,
So
and that dynamic aspect of DDAP is what makes it so good, and
right.
how it's what makes it stray away from any other indicator.
Right, and it keeps it basically basically in line with the overall. Like you said, they catch they catch each other, right? So DDAP might not shift bearish trend, even if ES is at 4,500 and ES falls apart and shits the bed, and that's what kept us out of a risk-on regime, right?
Mm-hmm. Yeah.
So it's very important that we look at the components like that. So um, let's go back to the dollar. Let's finish up on the dollar. The dollar is much higher than it was. It's actually still holding its upwards trend, right? If we put DDAP on the dollar, we can see that we'll zoom in a little bit. The dollar is well off Momo. So the dollar has a lot to do before we even think about like, oh man, maybe something's going on here that we need to be concerned about with liquidity. A falling dollar is just right. Is just as you can see with ANFCI, when the dollar plummets, liquidity conditions just get looser and looser and looser. Vice versa when the dollar rises. So we have a divergence here now between the ANFCI and the dollar. They're both going down rather, right? But the dollar's holding up much stronger, which makes me think that the ANFCI is maybe the peak isn't in yet, but we'll see how the risk on, or I should say risk off regime builds from here. Or I should say that the ANFCI is not going to stay negative for that long. It'll go back to positive territory because financial conditions, as long as the dollar is ripping, very hard for them to become loose because the demand for the dollar remains so high given the stance of the Federal Reserve compared to other banks. For example, let's talk about the European Union, the ECB, real quickly, right? So the ECB is hawkish, but not as hawkish as the Fed. The BOJ is hawkish, but not as hawkish as the Fed. The dollar is comprised mainly. The biggest components are the euro and the yen. So if the BOJ and ECB are not as hawkish as the Fed, well, then you're going to see more people want dollars than they do Fed than they do those other currencies when the Fed has to act with high inflation, right? Because the Fed, even though they're behind the ball, they are less behind the ball than the other two countries.
Yeah, say what you will about the Fed, but they're playing this they're playing this very masterfully.
Yes, they are.
They
They're a
they've been
brilliant
killing it.
organization.
They've been
Yeah, they're a
killing it.
brilliant. They're a brilliant organization, right? Like they know what to say and how to say it to the markets. Remember, their biggest thing is not to scare the markets. So if they're gonna say things, they're gonna try and scheme it in a way that's like, oh, like we don't. It's on the borderline. We said that it's on the border of being like misunderstood, and we said that I think 2 podcasts ago, where the Fed came out and said that we're gonna go meeting by meeting. That could mean two things. But the market's going to perceive it. Again, I think the Fed's getting exactly what they want. They're getting a rally in risk assets to raise rates further into.
They've got a cushion now,
Yeah.
which
And
is why they played
brilliant.
it so well. Yeah,
It's
they're
brilliant.
nothing nothing changed at all. Look at the EFFR. There's actually another rate hike priced in. Let's
Into
actually talk
March.
about that now. Let's segue into CPI numbers that we got last week and how the market reacted to that.
Yeah, actually, you know what? Speaking of CPI, let's break down. Let's do the important recap real quick. I did forget to do that, but let's cover that real quick. It's only like 5 or 8 bullets, but we'll cover that and then we'll go into the EFFR curve because we did see some things come in and actually accelerate. Which again, remember, data points are not to be. It's not about the singular data points. It's about the whole picture. So we had preliminary readings for non-farm productivity quarter over quarter as of the second quarter come in at negative 4.6%, which was 10 basis points stronger than expected. And this was an acceleration from the prior figure. We had preliminary unit labor costs quarter over quarter as of the second quarter come in at 10.8%. This was 130 basis points stronger than expected and was a deceleration from the prior figure. And this was the big one. We had core CPI, which for those that don't know is X food and energy. And we're going to speak about the EFFR curve and CPI in a minute. But year over year, as of July, came in at 5.9%. This was 20 basis points weaker than expected and in line with the prior figure. Then we had headline CPI, which includes food and energy, year over year as of July, come in at 8.5%, which was 20 basis points weaker than expected and was a deceleration from the prior figure. We had core PPI, which is the producer price index, X food and energy, month over month as of July come in at 20 basis points. This was 20 basis points weaker than expected and was a deceleration from the prior figure. So across the board, we saw a deceleration in pretty much all inflationary numbers, which added to the fuel which was fuel for the rally, which we saw in equity indexes in the last week. And then we had PPI month over month come in at negative 50 basis points. Again, this was a deceleration. And then we had initial jobless claims come in at 262,000, which was 1,000 weaker than expected, but was an acceleration from the prior figure. Finally, on Friday, we had export price index month over month as of July come in at negative 3.3%, which was 220 basis points weaker than expected and was a deceleration from the prior figure. And then we have import prices index month over month as of July coming at negative 1.4%, which was 40 basis points weaker than expected and was a deceleration from the prior figure. Finally, we had preliminary Michigan consumer expectations come in at 54.9, which was a 6.5 point increase than the prior figure, so it accelerated. And then we had the Michigan consumer sentiment, along with expectations, as I just said, come in at 55.1, which was 2.6 points stronger than expected, and this was also an acceleration from the prior figure. And let's go back into the EFFR curve. I just wanted to make sure we got over those important releases, so everyone's up to date. When we talk about this, it's not and nothing's foreign. So let's talk about the forward curve. We are now seeing a 82.2% chance of a rate hike in March. And Artie, you want to take it from here? I know you had something you want to talk about with this.
So we didn't have before CPI, so that's new. Start of 2023, markets pricing in another rate hike, a singular rate hike, so 25 basis points, and we're still not seeing cuts at all. So essentially, this rose the terminal rate on the forward curve. So we're now at a terminal rate of 3.72. Just a week ago, we were at 3.4. So
right. And
we keep seeing rises, and this could even rise all the way up to 4%. That's not out of the question.
I think the most confusing, or I should say the most fascinating part about this is with CPI slowing, we saw the terminal go up.
Yeah, just when everyone's thinking inflation has peaked, the market is actually pricing in more rate hikes, meaning the market doesn't think this is enough to stop inflation.
Right. And now we're seeing an 82% chance of a rate hike in March. This was under 50% for pretty much the entire time, right? This was at like a 10% or 11% probability of one rate hike. Now we're at 82.2%, which is quite interesting. And we still don't have a pivot. And we made this very clear that a pivot is not this, where the Fed's pretty much holding rates up. A pivot is when we see acceleration rate cuts. I'm talking 1, 2, 3, 4 cuts being priced in the future. We don't see that in the next 12 months. Now, go out 18 months, longer you go out, the more you're going to see expected rate cuts. But this is not what we're looking at right now in the next 12 months.
Well, also, the longer you go out, the less accurate it is.
That's why
there isn't really a point in even looking out that far.
Right. Again, we look at 12 months because that's the most, you could look at today and say, okay, where are we going to be a year from now, right? Anything realistically, I mean, if you really want to break this down, anything over 3 months is probably a little suspect. Like this March meeting, this 82.2%, anything can change this number, right? But the September meeting, a lot is going to have to happen to change this number.
Mm-hmm.
Right?
Yeah. So we have a guaranteed 50 basis point hike with a potential 75. The Fed could definitely come out with a triple rate hike again next time.
Right. Which would be very interesting. I mean, if they do a triple rate hike, right, it's going to affect the forward curve, right? Because now you're getting more in here. So that if the terminal is priced in at 372 and you get an extra rate hike here, right, something's going to most likely get taken away from here. Maybe something gets added over. It's all a dynamic. It's a dynamic formula, or not, I don't want to say a formula. It's a dynamic environment, right? So as something more aggressive may happen here, over time it'll bleed out and get balanced out here, unless something really happens where the Fed's going to hike 3 and then 2 and then 1 and then 1, right? Everything really changes. And then obviously the odds of rate hikes rise in the shorter term because the Fed's going to have to cut quicker. Because we know, and the reason that that happens is we know that the Federal Reserve cannot hold rates at high levels for a long time. But unfortunately, we've been the market has been giving this false idea that the Federal Reserve cannot hold interest rates up. Given, just look at the situation we're in. We're at 233 basis points right now. Okay. This is not extremely high for the environment we're used to. And I think we could pull that up. Can we pull that up here? Yeah, we're going to pull it up right here for you guys so you can see. Let's see. So this is where we are right now. Let's go to a weekly chart.
Yeah, we're where we
Terminal,
were just 2 years ago.
yeah, 372 is where we are right now. And it's funny, every time, literally we're at a rhythm now. Every time I open this, we have to move this up.
Mm-hmm.
The terminal just keeps going up.
So terminal.
Um,
Okay, I thought you were talking about the actual
no, the
the
actual
the
right now.
spot.
Yeah,
So
the
the
spot.
spot is where we were 2 years ago, but
Yeah,
the terminal,
this,
we haven't been there since 2008.
right. Um, I was talking about the spot, but we'll talk about the terminal too. That's a good way to look at it as well. The spot is where we are 2 years ago, and we were only able to hold this for pretty much. I mean, December 18 to September 19th. Excuse me, July 19th. So think of it like 7 months, and then the shit hit the bed. Or excuse me, the shit hit the fan. Um, so now we're expected to go all the way up here, and the idea is, oh, the Fed's going to get up here and going to drop. And we've done we've shown many examples of this in our prior podcasts that when inflation starts to accelerate above 5-6%, the way to cure it is to get the effective federal funds rate above that rate. Historically, that's the only thing that's actually cured it. So for that to happen, one of two things needs to happen. The terminal needs to go up way more than where it is right now, or the rate of inflation needs to come down way more than where it is right now and need to meet in the middle somewhere. Maybe if it's three, maybe it's here in the next 6 months. I doubt it, because inflation's at not 8%. It would have to really just some catastrophe needs to happen,
Well, the
right?
the job market needs to collapse essentially.
Right. And I mean that's gonna we're pretty much we're not there yet, obviously. I mean, we're pretty much at the tightest labor market we've seen in a while,
Mm-hmm.
right? So
Yeah.
like that's not going to really get heated up until we start to see some economic conditions really deteriorate. Now they've been deteriorating, but not at the rate at which inflation needs them to. We need ultimately what we need is demand destruction. What I was trying to say is let's overlay the inflation rate for those so everyone can see this. Okay, let's make this white easy to understand. Okay, so here's the inflation rate. So inflation's at 8.5. Inflation's at 8.5. So terminal's at 372 right now in March. Meaning at some point the rate of inflation is going what ends up happening is if you don't control inflation, you get the 1970s thing where inflation comes down, everyone gets complacent, and then it rips, and it's even harder to control afterwards. So the Federal Reserve knows this. They are not stupid, but they're trying to mask this up into a way where they can basically tell you that they got inflation under control, but they really don't yet. Will they eventually? Yeah, they're going to get it under control at some point. But what ends up happening here is when inflation's so high and the Federal Reserve is so behind the curve, right? To cure this issue, this needs to get above, historically, every single time inflation was above, I think it was 4 or 5%, right? The effective federal funds rate had to surpass the rate of inflation to fix the issue. So for this to happen, okay, this orange line has to overcome the white line. Now, I'm not saying that the federal funds rate is going to go above 8.5%. Is that possible? I mean, it would be crazy, right? But we're not going to go that route. We're going to say at some point, most likely they meet in the middle somewhere, right? Unless there's we have a really, really sticky inflationary environment where Fed has to go berserk, which, I mean, we don't know that that situation is here yet. But let's get back to the point of the Federal Reserve having to raise rates. The terminal as I said in the prior videos, is likely a placeholder. The Federal Reserve is going meeting by meeting because they have a feeling that the terminal is going to go up. The terminal is going to go higher than where it is right now to fix the problem we have with inflation right now. But they can't tell you that because they have to put it in such a manner that they are going to protect equity market and protect the financial system in the process of doing it. They're basically going to hike rates without. They're telling you that they are going. The way it seems, again, it's not definite, obviously, but the way they're laying everything out is they're going to hike rates by telling you today, but making the market think like, oh man, maybe inflation's like going to be under control without the Fed having to do too much, right? But the market's not obviously believing that to the extent because we're seeing the terminal continue to go up. If the market thought that the terminal would be shitting the bed, we'd be getting rate cut expectations. Bonds would be pivoting, right? The Fed pivot would essentially happen where bonds catch the bid. They're not. They're not catching the bid because the market knows that the Fed's likely going to have to do more. We just don't know how much yet. And that's what time will unfold as we do more rate hikes, as we get more inflation readings. The market will better understand that. And because the Fed's not so hawkish up front, right? They're not so aggressive. The market's taking a little breather here. But all that has to happen is the Fed needs to come in and basically get closer to this terminal, right? And push higher. Like once this terminal picks above 4%, I think things will start to get wonky again. Because now it's like, oh, we're not in the threes anymore. We're now in the fours. And then, the terminal could easily, we said this a couple weeks ago, right? The terminal could go to 5%. Right?
Yeah, that's
Yeah.
totally reasonable.
Now, would it be
for
shitty?
8% inflation? That's
Yeah.
definitely reasonable.
Now that might be where they cross at some point, 5-6%, right? 4 to 6%, they might converge, and then Fed funds rate would be above inflation. Oh look, historically it lines up again. Inflation's fixed. That's what has happened in the past. Could it be different this time? Yes, it can be. But I want to make note that where we are in the federal funds curve, it's not telling us that there's a Fed pivot. There's no Fed pivot here yet. Now you can look out like you said already, or later in the curve go out, but like that's unpredictable. Like okay, the Fed's going to cut in 18 months from now, or whatever. Yeah, okay, yeah, like how are you going to price in 18 months of price? I mean, the market's going to do it because the market again is the best processor of information. But as it processes information further and further on the curve, that information is processed with less validity, right?
Yeah, and at that point, it's like, well, what are you making investment decisions based on that?
Yeah,
What's the
no.
point? Why?
Right, because the market's trading today. It's like, okay, think of it like a pie, right? And the 18-month out pricings and all these things that are way out on the curve, those are like the crust of the pie. They're there, they're okay, but it's not the core. It's not the good part. The good part's what's happening. The market's pricing in the short term, like anywhere from 3 to 6 months. So that's what we pay attention to. That's why we have the estimated FOMC rate hikes / cuts for 12 months only. We could show you more, but there's no point. It's useless. So we focus on what matters. And I think we should talk about, it's important, but before we wrap this up, on what happened with the inflation numbers, on how the market's pricing that in with commodities, and we're going to go over that in a second. But before we get that, I'll get to that. I want to talk about the balance sheet because these kind of go hand in hand, right? We saw the market rally on weaker than expected inflation numbers. Cool. But we also have this balance sheet that's going to slowly fade, and it's going to slowly compress, or not compress, but decline. Right? We're off the highs. We're coming down, slow and steady. Now, that is not good for VIX. Historically, we posted a chart, a chart of this on Friday on our Twitter. But historically, when the balance sheet drops, as you can see right here, and it basically declines, liquidity is getting drained from the market, right? Liquidity is getting sucked. And what's happening is VIX is actually going to start exploding. Notice that when the balance sheet rises, your VIX explosions are pretty much non-existent because liquidity is just being supplied in excess. So it's very hard for markets to really get unhinged. But as we have this roll over now and come down, this is not going to be good for VIX. Ideally, realistically, VIX can see much higher prices and actually is oversold.
Yeah, so we're still in a breeding ground of high VIX levels.
Right, which is why we added to the position we did on Friday, because realistically, given the rate hikes coming up, right? Which the market pretty much prices that in. Like that's not going to be like, oh my god, rate hike. The market knows there's two guaranteed hikes at this 200%. I should not say guaranteed, right? But 200% chances of two rate hikes, and then 100% chance of two rate hikes, excuse me, and then 40 something percent chance of a third rate hike. So if the Fed comes in with the third rate hike, oh, it's a little surprised, but it's not like the market wasn't expecting at least two, right? And that's why the market is front running, pricing this in. So as the balance sheet fades, VIX historically has very volatile session, or it's a very volatile period for VIX. So that's why we are not so convinced that it's going to be risk on right away. If the system and the market line up to it, remember, our opinions we leave at the door. But since our opinions are lining up with our system, we're going to lean more on them. And as the system changes, it's not our opinions that matter. It's our viewpoint that needs to change. So we need to look at all the things why it could be risk on, analyze them, and say, okay, this is why it's risk on. But right now we have all the viewpoints of why it's risk off because the system is telling us it's risk off, and we went over this last week. But before we go into the final part, which is the inflation number, or how inflation affected the market, let's talk about the balance sheet fading, right? So yes, this is QT. This is going to happen. The Fed has made this apparent. Is it happening at a slow rate? Yes. But any decline in the balance sheet is over time is seen as a liquidity suppressor, a volatility enhancer. So you need to pay attention when you see the market ripping up the way it's doing 200-300 basis points a day. It's running. This is because liquidity is low and will continue to get low, which is why you're not seeing the dollar fade. Right? We went over this earlier in the podcast. And I know I'm speaking fast, but I just need you guys to understand that the dollar is holding up way better than other liquidity measures such as the ANFCI because the dollar is the supply of what liquidity is made up of, right? Liquidity is not food, it's not cars, it's dollars. So if the dollar
It's the most
remains
real time way
right,
to gauge liquidity.
right. So if dollars are in high demand, right, meaning cash is king, dollars are higher. Well, that means there's less cash for other things, lower liquidity. So the dollar is telling you that the liquidity has not bucked trend yet, meaning it's when we see the dollar break lower and basically fall apart, go bearish trend, so a liquidity surplus, right? Okay, VIX compressions, money's flowing everywhere, everything's invigorated. Oh, buy every dip. This is not the environment you're in right now. So if you're seeing the markets rally, don't get too like, oh my god, I'm gonna miss the move. Like, no, leave that shit at the door. We're taking it step by step here, and the way we're gonna end off this podcast is talk about commodities because this is very interesting. So in orange here, you have the inflation rate year over year, and we have commodities. So we had the last reading at 8.5%. We saw that this week for July, excuse me, and it's a decline. Now it's pretty much the same as it was in March. But in March, the world was ending. Now it's all better. Interesting, right?
Yeah, it's funny how
But
that works.
right,
We're in the
but
exact same spot just a few months ago.
yeah, and commodities on the other hand are around the same value, right? But as of the CPI report, we actually saw commodities jump. Okay, so commodities are now up post CPI report. They're actually flat on the month now. So if they rip from here, okay, they're going to produce a positive August month value, meaning in September, when we get August's CPI, it'll be more fuel for this to bounce. So what this is telling you is, yeah, okay, inflation's at 8.5%, but as of right now, it's not looking like it's going to be significantly lower next reading, right? Because again, this is also year over year figures, so you have to pay attention to where it was a year ago. So regardless, if we go look at in August 2021, right, where's commodities in August 2021, right here, right? It's automatically going to be higher, and the CPI is going to stay sticky because the index is the basket of goods that we're measuring is just higher overall from a year ago, right? You're comparing year over year numbers. Even if commodities go sideways, the year over year prints will still be relatively high from where they were last year. The problem is if we start to see this actually accelerate higher, like what happens when this goes back up to 30? The commodity basket goes back up to 30. Well, that's not going to be good.
No,
The
not at
market,
all. Well, same with crude oil, right?
same with crude oil, right? Well, crude oil, actually, we'll pull up crude oil because where is
Crude oil
that?
is looking a lot like DBC. It's kind of basing around down here as well.
Right? So we have crude oil, right, off the highs, basing. We'll put on DDAP. Oh, bearish trend. Cool. We've seen, just don't think because it's bearish trend, like, oh, yeah, crude tops in, whatever. Yeah, we saw that over here, right? Bearish trend. Oh, it tops in, blah, 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 blah. When the trend doesn't line up with the regime you're in, you got to be careful. Remember, they catch themselves. They should be lining up together. They should be working in tandem. When something's not working in tandem, look at the bigger picture. The bigger picture is stagflation. That's the bigger picture.
Yeah,
Everything's pointing towards.
stagflation. Nothing works in tandem. Stagflation is the shit regime where it just tricks everyone. So
Right. So a
that's
squeeze in
you got to
oil.
take it with a grain of salt. A squeeze in
Right.
oil is definitely possible.
Right. Given that, and we saw that over here. This was stagflation, right? This is exactly stagflation. Oil went negative. I mean, excuse me, not negative. I apologize. Oil went bearish trend. Oh my God, peak in oil, peak inflation. Now look what happened to oil. Oh yeah, the Ukraine problem. Okay, well, oil was already up before Ukraine even hit. Oil broke a new high before Ukraine even happened. So forget the Ukraine situation. That just exacerbated the problem. And we said that since day one. We said Ukraine is just going to exacerbate the inflation issue.
Yeah,
And
it was
literally,
not the cause for it. It
no, it
was
just exacerbated it.
exactly.
Now, long story short, we can see a rising, just because commodities are bearish trend at the moment doesn't mean that they're done. It means, but when we get a deflation reading on the system regime, it's like, okay, this point, we have an idea that peak inflation is probably in when deflation picks up. Because at that point, the weighting of inflationary components of the regime are decelerating greatly enough to where we're in deflation. We're not seeing that yet. So you have to take this with a grain of salt. We're in bearish trend right now, but we're not in deflation yet. Matter of fact, inflation is overtaking deflation, meaning that there's higher odds that that commodities can continue to see a bid and can go higher than previously thought a week ago. A
Yeah,
week ago, it was more likely that deflation would take over and basically crush commodities, right? Crush yields, so on and so forth. Well, in an inflationary environment, commodities and rates both go up. So this is actually more likely now than it was a week ago against deflation. So the deflation, the pivot camp is losing momentum. They're losing momentum
yeah.
from
The
last week.
pivot camp is somehow getting crushed even harder than they were.
Yeah. Now it's like, oh, rates can go up and commodities can go up. So your short rates, your short oil is your short commodity basket, and your long bonds are gonna get double fucked.
Now we're actually in a position where we can actually start thinking about will growth return,
Yeah, I mean,
and
that would be crazy. That would be
that
crazy.
would be the ultimate soft landing. I don't know how they would pull that shit off,
I mean,
but
yeah,
if we somehow get growth back in a rising rate environment and inflation pulling back, that would be insane.
yeah,
It's
yeah. I mean, ridiculous.
it's ridiculous. You know, it's hard to even think of
It's
how
never,
they
it's
could
never
do
been
that.
done. It's never been done.
Yeah,
It's
but
a soft landing. It's
it's
never been done.
something that we gotta take into consideration.
Of course.
If our system is saying that, then we can't just brush it off. We have to consider it.
We're not naive in that aspect. If there's going to be a soft landing and it happens, our system's going to pretty much pick up on it first, right? And we're going to have to take it because there's always a first time for everything. Is it extremely likely? No, which is why we lean in the risk off. Like we lean in the fact this is going to be a longer risk off environment, a more shitty risk off environment, because again, stagflation is the worst performing risk off regime, non-directional, right? But if anything does happen, we have to take it as it is. If inflation does take over and and DDAP aligns with the system, we're going to have to say it's time to go risk on. But until that happens, we're going to lean on the risk off regime because that's where we are. We're seeing stagflation still hold over a 10% lead on both inflation and deflation. So that's the sticky one. And the system strength, well, let me put it to you this way. Stagflation is still the sticky one with equity markets rallying the way they have. Meaning, with all this, we're still not seeing a huge fade in What are we seeing? 5-6%, right? It's not down enough where it's like, oh my God, we're like tied with all the other regimes now. So it's still strong enough to the point where we have to lean. We have to say this is stagflation until it's not, and that's how we play it. That's every regime by regime, day by day. It's stagflation. It's risk off. Economy is going to shit until it's not. We're
Yeah,
in a recession. We're in an inflationary recession until we're not. And
exactly. Just kind of like it's just how the jobs numbers go,
yeah,
like
and
unemployment is low until it's not. Eventually
right,
shit's going to hit the fan. They're going to raise rates to a point where they really do destroy the labor market, and
and
it
demand.
happens all at
Yeah,
once.
and in the process they're destroying demand. And I think the point that I'm going to leave this podcast off with is the narrative of what the Fed's doing. Everyone's like, oh, midterm elections are coming up. The Fed is gonna have to pivot. Let me tell you something. Number one, we have midterm elections. We have a Democratic president, right? Powell's a Republican. So what does he? If you really think about it, what does he give a fuck about if he has to tighten into midterm elections? He's a Republican, right?
Hmm.
By party, he's a Republican.
Well, I mean, I'm
Number
sure
two,
there are democratic forces
against him, I'm
against
sure.
him trying to
Right,
get him to do what they want, which, that's how it is. That's politics. Unfortunately, the Fed is involved in politics because they have such a large influence.
right. But more importantly, outside of Powell being a Republican, do you think CPI gives a fuck about the midterm elections?
Yeah, definitely not.
Like, do you think this?
Inflation's gonna do what it's gonna do.
Do you think CPI is sitting there like, oh shit, midterm elections? I best go to sleep for a little bit, calm down. I'm getting a little too riled up. Absolutely not. That's not. That's not how it works.
Yeah.
You want to talk about being data dependent meeting by meeting? Hmm. Forget the midterm elections. You got a problem on your hands. You got inflation that is extremely high. Oh, it's peaking. It's still rolling over. Okay, it's peaking and rolling over. Yeah, you know what? You could have said that in 1970s. Oh, look, inflation peaked. It's done. Shortly, a few years after, the effective federal funds rate was north of 10%. Just you have to take this step by step. Politics aside, market aside, you have to put it in the perspective of what's going on. And I think that's where we're going to finish off the podcast. Take the market day by day, meeting by meeting, data point by data point, in the bigger picture of what's going on right now, step by step. This is not going to be something that tomorrow we're going to just, or Monday, excuse me, we're going to get a deflation. Oh yeah, we're in a deep deflation. Bonds were the trade. No, that's not how this works. If you look at the curve here, by the time the bonds or anything is a trade, the system has picked up on it already. So you're not late to the party. Historically, you're actually pretty much always on the dot. Even when you're late, you still catch the move. So it's like, why sit there and stress yourself out about nothing? Better off taking it step by step. Enjoy your life. Go out, have a good time. Know that, okay, listen, I'm going to take this day by day. The bond interest rates are the 10-year yield is not going to go from 2.7% today to 1% tomorrow. So like take it day by day. And if that does happen, we have bigger problems on our hands. That's COVID level shit. Okay? Where you drop the interest rates from pretty much 2-3% down to zero or 1.1%. It was like 1% here, right? We were here. Yeah, we were at 1.5% to zero in 2-3 months. That's the worst environment we've ever seen. So take it day by day. This is what normally happens. Look, we see the decline. Look at this. Federal funds, when they pivot, look at this. Cut, right? Even back here. This was the 2008 financial crisis. For them to cut to zero from September 2007 to December 2008, it took over a year to cut to zero. If there's a cut, it's going to be nice and slow, patience, so you can take advantage of it. Don't be scared. Being scared doesn't work. And I think that's where we should leave it off today. If you have any questions, feel free to reach out to us at the Market Radar on Twitter, our Discord. Um, the link to our Discord can be found on our website at www.market-radar.com. And if you have any topics you'd like us to discuss, please drop them in the pit. We'll go obviously take it into consideration. It's very hard. We try to keep this under an hour, so it's very hard to fit everything that's gone on in the week and new topics and what we want to talk about in the same video. So we appreciate all recommendations. And we hope you enjoy this, and we hope you come back to see us next week. Thank you. Have a great weekend.